Hey, everybody. And before we start the show here, I just want to remind everybody to contact us at podcast@nationalland.com. Let us know topics that you want us to cover or guests that you would like to hear from. Reach out to us and let us know how we're doing. We want to hear from you. Hello, everybody, and welcome to episode 109 for the National Land Realty Podcast, where we discuss all things land. Our goal here is to inform, educate, and entertain those of you who own land or are interested in the buying and selling of land throughout the United States. My name is Mac Christian, and I am the Chief Marketing Officer here at National Land Realty. I'll be your host for this episode. Now, I got to throw a disclaimer on this up front. I have recorded this intro probably... I'm just not going to tell you how many times because it's embarrassing. I do this and I write things down, and if you watch the YouTube, you can normally spot me doing it because I don't really try to hide it. I read the notes because I want to get them right, and I want to do credit to my guests and make sure I get the information in front of you. And I watched it, and it's just too robotic. I hated how I did this intro today. So here I am throwing away the notes, and I didn't actually use paper for the notes. I just wanted to do that for dramatic effect. And if you watch this on YouTube, it's very dramatic. But if you're just listening to the audio, that makes no sense, and you might have heard the paper rattle. Anyways, today is a really cool episode. We are talking with Jackson Takach. Jackson Takach is the Chief Economist and Head of Strategy Research and Analytics at Farmer Mac. What that means is he has an insight into agricultural markets and the U.S. economy that you or I, looking through the news on a daily basis, probably do not have. And even if we do have some knowledge to let us grasp some of these things, we're still not going to be anywhere even close to what Jackson provides. Today, we're talking about interest rates. Interest rates have recently dropped, and we want to talk about what impact that's going to have on agriculture as well as land values. We're also talking about new information releases from the USDA all over the board as far as crops and commodities. And I think we even getting to some Schrodinger philosophy somewhere along the way. So if you are into land, if you have an interest in land or agriculture, this is a must listen to episode. Jackson graces us with his presence once per quarter, and we get to hang out and talk and have some fun. And the information that he provides is tremendous. Now sit back and enjoy. Okay, I am sitting once again with Jackson Takach, and Jackson, you are the. I have a hard time asking you to go through the whole your background and everything. Chief economist at Farmer Mac. You hold a series of titles there.
A lot of commas. Yeah,
a lot of commas with your name, and well, we're just gonna say the economics person of agriculture. Brief background. We'll keep it brief. I'm not going to put you through the whole thing again. But go ahead and touch on a little bit of your background and what Farmer Mac is.
Well, I appreciate you having me back, Mac. It's a pleasure for our regular chats here. They've become a staple on my calendar. So happy to be back and talking to you again. Jackson Takach, right? Chief Economist, VP Strategy, Research Analytics, all those commas in there for Farmer Mac. I grew up in a rural town in Scottsville, Kentucky. Grew up baling hay and all the things you have to do to tobacco and in that neck of the country, moving cattle, doing all the things that a rural Kentucky kid does. Went to school, studied economics, and then found my way to Washington, D.C., which wasn't, my neighbors were a little bit concerned about me. Hey, you're leaving this great Commonwealth and moving to another Commonwealth in Virginia. But started working for Farmer Mac about 19 years ago. So I've been here at Farmer Mac for 19 years. And if you're unfamiliar, if your viewers here are unfamiliar with Farmer Mac, fabulous organization, institution, secondary market for ag real estate mortgages, agribusiness loans, supply chain lending, and rural infrastructure. We're not a retail shop, right? You can't walk into us like you can a bank or a farm credit system institution or a credit union, anything like that. Instead, we work with all those institutions in order to find ways to provide more liquidity, more capital, better choices of product. I feel like, the best thing an economist can do is provide choice and optionality to consumers. And I think that's what Farmer Mac does as an organization, as an institution, providing more capital for all those financial institutions that are wonderful in providing capital for farmers, ranchers, rural Americans from coast to coast. our institution works with them to provide more options and more capital to the people they serve. So it's been a great run. Loving it. I get to do things like this, talk to you about what's going on in the world, what's going on in economics and agriculture, and wouldn't change a thing about it.
I like to say that if anybody has a loan on agriculture or land, chances are it originated with you all. In your area, and so that's kind of how they work. Is they supply they're the supply chain. They're the top of the chain. So the big. I mean, we can jump right into it. I feel like we kind of we jabber here before we kick in to make sure we have our ducks in a row. And the obvious low-hanging fruit conversation is interest rates. They just got cut for the first time in a good long time. So tell me what that means from your perspective, and we're still pretty fresh into it. I want to say, we're a week in. I would say the ripple effect isn't complete yet. We don't know what it's going to do economically, but I think that somebody in your seat probably has an idea. So tell me what the interest rate cut means, and what we can imagine that doing to the marketplace.
Boy, that's like a Christmas present of questions to unpack there. Let's start with maybe what it does, right? So, Federal Reserve is really in charge of monetary policy for the United States, central bank and banking regulator for the United States. And they're really in charge of trying to maintain price levels, maintain full employment, keep the economy humming. And they have a lot of tools to do that, one of which is sort of that base interest rate that everybody, that essentially banks have to pay in order to access capital. So it sets the sort of floor for short-term funding for the rest of us out in the world. The Fed has been slowly increasing rates. I'd say slowly, but it felt pretty rapid to me over the last few years to try to slow the economy down. And now they're saying like, hey, the economy seems to be pretty solid. It's not overheating the same way. We're not seeing all the same signs of high inflation. We're not seeing all those things. So we don't feel like we need to have as restrictive a policy, so we can maybe ease back a little bit. And then the other thing we're trying to maintain is price levels, and we're not seeing inflation going up the same rate that we did. So maybe there's room for us to start to take a little bit of air out of this balloon that's sort of restricting some of the capital flows in the marketplace. So they cut a half a point, which is a significant amount. That's 0.5 percentage points if you think about it in terms of absolute percentage points. It's a slow burn into the economy, so it will immediately affect short-term rates. So if I'm a farmer, I'm thinking about my operating line. If I'm maybe a residential borrower, I'm thinking about my home equity line of credit or my credit card debt. Those are the things that are really tied to that short-term interest rate, and those immediately start to get cheaper starting next month. It really takes about a month to lag that effect in. So everything starts getting a little bit cheaper in terms of interest expense next month. For farmers, it will really take about 6 to 12 months to start to be impactful. The prime rate moved overnight, but a lot of loans that are attached to that prime rate will start to reset in over the winter. So January, February, March, you're starting to build up your operating line to put stuff in the ground or buy some cattle to expand the herd. That's going to start to kick in later in 24, early 25. So it's going to take a little bit more time, but it is impactful and will start to lower the interest expense on consumer credit and agricultural credit starting in the short term. Long-term stuff, completely, the Fed has really no ability to influence that outside of buying, long-term debt. That's the only thing they can do is buy treasuries or buy mortgage-backed securities to try to lower debt. They're not doing that this time, right? So they're really only lowering that front end of the curve. Long end of the curve may go up, may go down. So a 30-year fixed rate's coming down right now, but it's not really a direct response to the Fed cutting interest rates. So long-term stuff, it's getting cheaper. That's great. Great news, I think, for folks who need credit. But it's not a guarantee that as the Fed cuts more, that rate will go down automatically. It's kind of subject to the whims of the market.
So this is so what we're seeing in, let's say, mortgages, 30-year mortgages, it's adjusting maybe because of demand, but it's not adjusting necessarily because of the rate cuts we just saw.
That's right. Yeah, that's right. There's certainly a relationship, but it's not one to one. Whereas that short term prime rate or anything attached to that consumer credit or operating debt, that's going to be a direct relationship to federal rate cuts.
Is it? This is more of a question because now you're inspiring some curiosity here about the marketplace. Is it behaviorally similar to what you would see in a stock index, where it's I view stock indexes as an emotional vehicle where it's the marketplace turns on somehow and you see something go up and down, and it could be somebody had a bad day. Yeah. And it's where it is a supply and demand thing that drives the price and the value, but it's not necessarily driven by the economic basis of it. Like I don't know if I'm making sense there, but
animal spirits, right? Yeah.
Yeah.
Yeah, so I think it's less subject to animal spirits. So the fixed income markets do operate very much in supply demand sort of equilibrium being that interest rate, right? So the market interest rate is based on how much are people buying that fixed income security, how much of that's available in the marketplace, and sort of where those two things meet. That's going to be your interest rate in the long end of the curve. Two things can happen. People can start to say, "Hey, I don't necessarily want to put my money at risk, in those long-term things." That drops demand and that raises interest rate a little bit. Or it can happen that supply really increases, right? So if you have supply really go up because maybe we're issuing a lot of debt, U.S. federal deficits increase the amount of debt on there. So supply could increase the interest rate as well. So there's a couple of things that can influence that. Right now, I think we're a pretty solid blend of supply increases being met well with demand increases. So people are interested in that fixed income security in that long-term marketplace at the same rate that people are, putting new securities on the marketplace. So you kind of end up with a steady state, right? The interest rates kind of hum along, but it can turn around. And there's lots of things that will push and pull that supply demand equilibrium. Very difficult. Hey, if I could tell you exactly what that equation is, I probably would not be on your podcast. No offense, Mac, but I'd be in, my own island somewhere, just like enjoying the frivolities of life.
If I also, no offense, if I could predict those things, I would not be in this. There would be a Mac Christian compound in the mountains of the Northwest that I would just stay there and no one would get to come in up the driveway.
Right. Send for my things, right?
Yes. Send a helicopter drop off at my house. Yeah, no, that would, yes. So when you're talking about the short-term interest rate, like the, next year's things, it's a delayed effect. The interest rate drops. And that's the rate of borrowing. And then you move on to the secondary market. Then they have to adjust what they charge for interest. And that in turn is what you get as the consumer. And it takes a while for that to happen. So you mentioned from that drop, for cattle, for instance, what is the time range that agricultural operators out there should look for in order, like if they were trying to maximize what they're going to get out of the marketplace, how long would you want to hold off from that rate cut to make any purchases that required leverage like that?
Well, I think in the short-term marketplace, everything's kind of done in a 1 to 3 year basis, right? So it tends to be a fairly short cycle. I would say, holding off to make a decision right now, I would say go ahead and take the bird in hand, right? We don't know if the Fed will cut again this year. I think the markets are sort of pricing in another 50 by end of year and maybe 25 by the beginning of sort of the renewal season, early 25. But credit costs sort of will recycle. So, you can refinance later. It's kind of one of those things that you're really making the decision based on the economics of the business and not necessarily like buyer's remorse of interest rates, right? So that's what I always tell people, like, hey, there's always an opportunity as long as you have optionality, if you can call the debt or you can refinance without penalty, then you don't have to wait for the lowest thing and try to catch that falling knife, right? Like you're better off just doing the things that are economic for you based on the current situation, and then you can always adjust that if rates go lower, right? So that's always my advice. to growers or any business who's taking on some of the credit or financial debt is very hard to time the market. Just like if you're an investor, it's hard to time the market. It's also hard to try to hit the bottom of interest rates. I remember back in 2021, interest rates were continuing to decline. I had people asking the same question, like, "Well, I can get a 4% rate, but I'm waiting for that 3.5% rate." I was like, "Guys, like, take the 4% rate. Like, that's." I hear you. I want to brag about my low interest rate as well, but on a farm loan, to get into a 4% 30-year fixed rate is insanely good interest rate risk management. I don't know that we're ever gonna see that again, right? Maybe we get down to 4% again, maybe we don't. So my advice was always like, you can have another bite at the apple if things go lower and stay low. But it's very difficult to get back into that position again. So, I'm not going to tell people to go out and, borrow a bunch of money today, or don't borrow any money today because it'll get lower. It's really got to do the things that are right for the economics of the situation and leave yourself the optionality that if rates go down, you can take advantage of it. Operating debt, I mean, you're going to a lot of that you're going to renew every year because you're going to pay it back and then take it out again next year to plant your stuff. And so you'll have another chance to enjoy lower interest rates in the next turn. And waiting an extra day or a week may make a difference, and it may not.
Yeah, I feel like just historically from looking at it, the only times to really hit the pause button in what you're doing economically is when you see a rise in interest rate, because the first thing you'll see is an overreaction in the marketplace. And then you've got this lag of a few weeks where things are kind of abnormally high and things haven't quite leveled out yet. But everywhere else, it seems to me, it's like you just got to do your business. And interest rate is just the environment that you do the business in. And
Yeah, and it's a risk like anything else. And
it
if
is,
you manage
yeah.
it the right way, and you're making smart decisions, you don't get too far over your skis one way or the other when interest rates move up or down.
I how many former hedge fund managers are out there that tried to predict the market?
Yeah.
It's same thing with interest rates and stuff like that. It's just that's just the environment. You get in when you get in and you get out when you get out, and it's just the environment that you're in. Unless there's a huge hike, and then maybe you hold off a little bit. I don't know.
Yeah. Well,
I don't think there's really a game to it.
what you're describing happened, right? When you look back 24 months, so the last 24 months, interest rates went up, and what people did was sort of pause
Hmm.
and say, I'm not going to make big changes right now, either sell or buy. There just wasn't a lot of land trading. There wasn't a lot of businesses stopping or starting. It was a lot of, I'm going to deal with the current situation. I'm going to make the economics work to the best I can, but I'm not going to try to predict big changes. I'm not going to go out and like take a huge loan and put a lot of risk on the table. But I'm also not going to de-risk right now because I don't know. There's a lack of clarity or greater uncertainty right now. So people just kind of said, you know what, I'm going to pause and do what I'm doing. And that's the reaction we got in the land markets.
So I want to derail the conversation off of land really quick because I would like quick detour, and I just want to ask your sort of insight on this because I know this is something that you pay attention to. But um, the interest rate, we've got Jay Powell in there right now, and we had like 300 years of Alan Greenspan, and then in the last little bit we've had Bernanke, Yellen, and Powell. And what has that done to the marketplace? Has that caused significant change in how things are done from an interest rate perspective? There was the Alan Greenspan days had a definite philosophy, and
Mhm.
then the Bernanke days were on the end point of the financial crisis of 2006. He was brought in to kind of get things back on track, and then we had Yellen and now Powell. Has has the Fed policies changed that much? And then I guess this leads into a conversation of new administration and appointments. Um, could that change, as we approach, the next term of a new administration? But I just wanted to ask from the Federal
Mhm.
Reserve perspective, have we seen drastic shifts in policy that really affect us, or are they just like pretty consistent and they're all kind of managing the same way?
I think it's a bit of column A, bit of column B. I think there's more tools deployed in today's more more modern central bank, right? When you think about ways to influence the economy, sort of the old school way was really interest rates, right? And I'd hit every problem with the same tool. Every problem is a nail, and I'm a hammer, and that's just the way I'm going to go about my business. And I think the more modern approach to monetary theory says, well, you can do more, right? You can buy assets, you can sell assets, you can influence money markets and availability in creative ways. And that was really a byproduct of sort of end of Greenspan, beginning of financial crisis, when they had to get more creative and find ways to use the balance sheet, adjust the markets, try to influence demand in order to salvage the U.S. economy in 2008, 9, 10, and beyond. So I think that's probably, the modern monetary theory approach is definitely more prevalent today, I'd say, in this Federal Reserve than it was 20 years ago. Now, yeah, I think the mandates really haven't changed. I think the concept of the central bank hasn't really changed. So there's a lot of things that are fairly consistent. One of the things that always strikes me is when I first started paying attention to these markets way back in the late 90s, early 2000s. I felt like there was more tea leaf reading, so it's like you kind of watch the posture of the Fed. I hear stories about the 80s, how people would see like the Fed chair carrying a briefcase out, and that meant he was taking work home, which meant they were they were studying something over the weekend, right? And so there were people like watching the houses of the Fed FOMC members and seeing how they reacted. Were they up early? Were they down late? Like what's the deal? And today, everything seems much more signaled, and they use the media more to sort of leak out what our intention is. I looked at sort of the betting markets, right? You can look at futures markets, right? I say betting, speculative futures.
I like
markets.
betting market.
Mostly hedging. Just like days before the the Jackson Hole press release, and it was like everybody was betting on 25. And then, Fed Chair Powell comes out and kind of says like, hey, the economy seems to be in pretty good footing. And we feel like we got an opportunity here maybe to relieve some of the pressure on. And all of a sudden the market said, oh, it's 50, right? Like because he gave the speech that he gave, it changed the interpretation of the marketplace. And I think 30 years ago, the Fed didn't do that as much, right? It was just sort of like the announcement came and it was, no setup,
Yeah, because Greenspan kind of behaved like an enigma. He would just pop up once in a while and be like, I am doing this, and then just vanish for days, for a year, and then pop up again. And then when you're talking about buying and selling on the market, is that the quantitative easing?
Yes, quantitative easing and tightening, right? So they'll what they realized in the financial crisis was there's all this, mortgage-backed paper out there. Nobody was buying it, so interest rates kept going higher to entice people to buy it. So they said, okay, well, we'll just backstop it, right? We'll start buying it. That drives up demand and drives down price. So interest rates came down because they were buying that asset. And so that was they were able to keep the long-term rates from rising because they were soaking up all the excess supply, right? So twofold, you get cheaper interest rates and you soak up all that paper and provide liquidity out to banks and other lenders out there. So it's kind of a double whammy where you can keep interest rates low and you can get liquidity out very quickly at the cost of buying assets, right? Like blowing up your balance sheet. That's the cost.
I'm going to test history here. Was that approach based off of what Japan went through with their mortgage lending crisis? Was that I'd read something about that with Bernanke and his philosophies, and I wasn't sure if that was that.
You got me on that one. I don't know the sort of the origin story of the.
I couldn't remember
how that one came to be, but then now you've given me something to read up on.
There you go. Okay, so as we've seen, we had and the interest rate the whole thing is just interesting. We had super low interest rates for a really really long time. As they've come up to stop inflation, is the Fed in a reactive state or a proactive state? Because it almost seems like when inflation started happening, they reacted, and I don't know whether they might have caught it on time. They might have been point on. They could have been a little bit behind or ahead. A lot of people have said all over the map.
Right.
Um, do you think they're right now in a reactive state or a proactive state with how they're managing it?
Yeah, that's a good question. I mean, I always hate the Monday morning quarterback,
Uh-huh. Uh-huh.
the Fed. It is so, that is a very difficult position to be in.
Yes.
And they could have been right, right? Like maybe inflation was transitory and it would have come down all on its own and we didn't need to raise interest rates, but maybe it wasn't. And so, they had to make the call that they made. I think if any word could be stricken from the tongue of 2021 to 22 would be that transitory word, right? Like transitory inflation. Oh, it's just a supply side problem, and maybe it was, but 8% inflation is pretty hard for consumers to stomach, and it's really hard on an economy. And so at that point, they're like, well, we got to do something, right? We
Yeah.
thought it was
Yeah.
supply chain driven, and it might work itself out, but there's a lot of money circulating, there's a lot of spending happening, and there's one tool that we really have to do something about it, and they did it. Today, it feels to me like they are probably leaning into. I mean, we still have some signs. There's some inflationary pressures in the housing markets and insurance products, and there's a couple of categories where there's some inflationary pressure. We haven't gotten back to 2%. But when I look at the relative interest rate level to inflation, I go, they've got some room to cut. They're at 5.5, right? Was the top. And inflation was 3.5 or 2.5 to 3. It's a pretty big gap there. So I think they're probably not reactionary and not being too forward looking in this, and just saying like, hey, we've actually seen things settle down a little bit. We have a little bit of extra room and are trying to be prudent with these decisions. Not do it too early, but don't wait like they did before too long and let things get a little bit hairy before they make the decision.
So you brought up reading tea leaves, and I want to jump back into it. We had in 2023, we're on the threshold of economic disaster, and we are definitely moving into a recession
Yeah.
that never happened. And 2024 goes off with no recession, and they call it the soft landing, right? We get to the end of 2024, and I'm not going to say it's happening again, but it looks like it's happening again, where people are saying recessionary conditions for next year, and you're starting to hear talking heads freak out a little bit. What does it look like?
Yeah. If you ever heard me talk, I don't think I've ever done a live presentation for UMac, but I always, like the last 12 months, I've probably been making this analogy of Schrodinger's economy. And so Erwin Schrodinger,
somewhere in a box.
there's right. This guy's, he's got to have some problems, right? There's some red flags with this guy, right? But 100 years ago, somebody with the new physics, right? Quantum physicist said,
Yes.
put a cat in a box, put some poison in there, put a radioactive material and a Geiger counter, close it up. The cat's alive and dead at the same time. That's the way this economy feels. There's like half of the indicators that usually line up, right? Our economic KPIs usually say it's either going good or it's not going good, right? They tend to kind of like tilt in one direction or another, but you've got sort of split signals today. And so our economy, if you're looking at a select set of economic indicators, it looks very much alive. You're buying kibble, you're preparing to take it out on walks or whatever you do with your cats. Things are looking pretty good. And so the housing market looks pretty good. The financial markets look pretty good. GDP looks pretty good. And then you've got these other set of indicators when you think about consumer sentiment, inflationary pressure, cost of food. You've got some weakness coming in labor markets. They're starting to weaken a little bit. And so commercial real estate, we've been talking about commercial real estate, waiting for that shoe to drop for 12 months. All these things start to happen. And you say, hey, maybe the cat, its time is up. Right. And we're planning the eulogy and having a service for poor Garfield. So I have a hard time. I ask crowds every time I talk, what do you think? Is the cat alive or dead? And it's 50-50. Not every room is 50-50, but I think my total cumulative count is 50-50. And this is hundreds of people I've given this analogy to. And in some places, people sort of feel that it's worse. And so they all raise their hand when I ask, is the cat dead or alive? It's not looking too good for Garfield. And then the other half, when I travel and I'm going to other places, their area might be feeling pretty good. They've got some maybe economic investment. Maybe the IRA brought in some investment capital delivery. Maybe they've got a new manufacturing plant and they're raising their hand like, hey, the economy looks pretty good to us. So it's really strange. It's something I've never experienced before as an economist, where you've got really split economic indicators, and it's hard to decide which way it's going to go. Could be soft landing, and we just kind of glide path into 2% growth, 1.5%, 2% inflation, and everybody loves it. Could be that we see a disruption and things get a little hairy. And I don't even know how to handicap the odds of both outcomes, right? It's a very tough call.
Yeah, is yield curve still playing a role in all of this, or is that sort of an afterthought now?
Yeah, I mean, it had a batting average of about 1,000, right? And so everybody trusted that yield curve.
That was the North Star forever, and then it flipped, and everyone freaked out, and then everything kept going, and it's like, oh, the North Stars, okay, yeah. Find a new star.
Yeah, and it's a tricky thing because it was such a reliable predictor of financial stress. When that yield curve flipped and the short-term rates were higher than the long-term rates, that said people were parking their money, right? They're not investing it in short stuff, and therefore, hey, maybe you're in for some trouble. And here we had a bit of a policy-induced inverted yield curve, which is different. I mean, it's just and so I think we've learned like, oh, okay, why it inverts matters, and how it inverts matters, and the path after inversion matters. And maybe we don't have a perfect. Now, hey, we could be talking in a quarter or 2 quarters, and all bets are off, right? Maybe the economy does tank. We're like, haha, see, I told you so. That the yield curve does it again, or it doesn't, and the yield curve goes back to more of a upward sloping curve, and short-term rates are lower than long-term rates, and all is right with the world, and we escape this one yield curve inversion with no recession. And I don't know, again, how to handicap the outcome, but we'll find out. I'll tell you this: we're going to open that box, and we're going to find out, is that cat dead or alive?
I like it. So the other thing that we talked about was agriculture data that just came out.
Oh yeah.
So this is one where I'm not going to be. I'm going to sit in the passenger seat in this one and let you tell me. We had new data come out, and you very much have been on top of that. Tell us what the data is showing, and what are we looking at?
Yeah, so the data you're referring to is USDA's farm income outlook. So this is kind of like you talk about the North Star of economic forecasting, right? The yield curve. Well, this is kind of like the GDP release of the U.S. ag economy. USDA every 3 times a year, they do it 3 times a year. They predict how the overall health of the U.S. economy is going based off of a few indicators of farm income, expenses, government payments, balance sheet health, all that kind of fun stuff. And they just put out new numbers earlier in September, and it was a pretty big upward revision, meaning they were predicting a bigger fall in farm income with the lower revenues, higher expenses kind of eating into the farm profits, right? It's a pretty well understood economic phenomenon right now, which the commodity prices are down, the expenses to produce those commodities haven't gone down as much, so farm income is being compressed. In February, they put out some pretty gruesome numbers, like the largest 2-year drop, a huge decline from 22 to 23, and then an even more decline from 23 to 24. And in September, they revised both 23 and 24 up by like 25%. Couple of things happened. They realized, we've got a whole another 4 or 5 years of data from the ag census. So they're able to incorporate a lot more nuanced production, expense level. They just knew a lot more about what farmers did from that ag census data that came in earlier this year. But they also got a lot more of a look at what it costs to farm stuff. So the biggest drop, the biggest change wasn't a revision of revenue. So everyone kind of says, yeah, revenue is going to be down. We're not changing that very much. But say, hey, the feeding cost for cattle, dairies, hogs, all those, poultry, you name it, corn price is low. Soybean prices are low. Alfalfa prices have come down. So all the feedstocks have come down. So the cost to feed have really has really declined considerably. So that's where the revision came from. It was 100% focused on the livestock sector, the protein sector, animal proteins, and seeing an upward revision in profitability in proteins. The crop side, still pretty sour outlook for 24.
Is that is that adjustment, is it the commodity price itself, or is and I realize this is a trick question because they kind of loop into each other, but is it driven more by the cost of the crop, or are we talking an input related change? Because I know that the heavy influence there for a long time was fertilizer
Yeah.
and the natural gas side of things, right? Like that really drove high prices that we saw. And then once we see the fertilizer costs, start adjusting, which I'll be honest, I never saw those coming down. I figured, once you got a profit line, you're not going to adjust it. But you
It
see,
did. Yeah.
so if you see that, is this related to that, or is this something altogether different?
Yeah, it's a little bit. So some of the price inputs for crop producers came down. So you're right there. Some of them went up. So it cost more for debt in 24, right? Interest rates were elevated. We'll get some relief in 25, but 24 stuff cost, the cost of money was higher. Labor cost more. So if you needed to hire somebody to work on the farm, the cost was elevated. Family living expenses were elevated. So you got some relief in the form of anything related to petroleum. So your fuel expense went down, your fertilizer costs went down, cost of drying stuff went down, and that gas cost went down. But you saw an increase in some of these other costs like seed and rent and a couple other things that probably stabilized your cost structure. Meanwhile, your revenue goes down 25%. So your costs probably stayed about the same and your revenue went down 25%. Now, if you're feeding cattle, your revenue probably went up a little bit, cattle prices went up, and then your cost to buy the feed went down 25%. So you end up as a protein producer in a much more pleasant spot than you were the last year when corn prices were still $5, $6 and you had to pay more to feed your herd. So that's the flip. It's really kind of like taking some of the 22, like 22 was a great year for ag if you're on the crop side. So some of the benefits there are maybe switching now to the protein side with the lower cost of feed. And there's this kind of ebb and flow. That's the way agriculture's been going for hundreds of years now. It's like what's good for the crop producer probably isn't good for the livestock producer, and what's good for the livestock producer might not be good for the crop producer.
This is the kind of stuff that, like, if your kids get older and they go into math, like, don't ever let them go into like commodities investments. They're either going to come out with, a twitch, or, they better be just like the calmest person alive. It's just
Beautiful minded, right? They got to just
it
see all the
is
numbers.
the scariest marketplace on earth. It's just so up and, but no, it's good. It's good to take note of, as we move along. Is there any kind of outlook for any particular crops that are holding stronger than others?
Yeah, no, I think the all eyes are on the corn and soybean markets, right? To see exactly, are we going to bounce off of some of these low prices? Is the international trade going to resume? We saw kind of a drop in demand for U.S. crops. People got their stuff from Brazil, or their demand came down. So it's just a bit of a recovery in the supply side. So what happens next? I think that's all eyes are on what happens next there. In terms of the dairy, I think dairy's doing quite well. So it's maybe a little bit of a rebound in the dairy. They needed it. 23 was pretty brutal. So here 24 maybe slightly maybe a return to average or better than average. So I think those are kind of the maybe the big news stories. Cattle cycles. I mean, I'm sure there's some listeners who have some ranch land or cattle on pasture. I think the cycle's looking pretty strong. I think everybody expects there to be a recovery in supply. Like as soon as price goes up, what do people do? They hold some heifers back and sort of build that herd. And that's just not happening yet. People are still sort of de-risking and saying, "Hey, I'd rather just go ahead and take the cash." Right. So the herd expansion hasn't happened, I think, the way it typically would, and that could hold for a little bit longer, which is I think music to the ears of some who maybe have some of those good sized herds out there and who are enjoying those high prices.
You brought up soy, and that's our largest export, right?
Yeah, it's a big one.
And I'm gonna tie this into the other thing that we talked about beforehand, which we're going into election and we're talking about trade. Soy is such a big deal because, you know, a lot of countries buy our soy, but one of our biggest customers is China.
Yeah.
And the elections are coming up. China's a very big part of the conversation there. I'm not going to get into partisan politics. I'm not going to put your feet in that fire. And honestly, I don't want my feet anywhere near that fire. Um, I take a lot of the conversations around election time as hyperbole. I don't think this year's any exception. But what I want to ask you is what actually does change in agricultural markets when a new administration comes aboard? Because I always joke about it that the stock market freaks out, everyone goes crazy, new administration gets on board. Oh, when the new administration takes over, and day one, nothing actually happened. And then you move on 6 months down the road, maybe a couple of things happen, but the market will react like, you know, your uncle at Thanksgiving. And so is there anything actually that we look at from past administrations? And I just want to take it as a just a general outlook. Are there going to be policy changes that we should be on our toes about that any president could come in for uh, during an election that could affect agricultural markets? I guess is the question. And tariffs would be one of those. But depending on, um, I feel like that's almost a partisan question because there's only one party talking about it right now. But let's just go with without tariffs and policy.
Yeah, well, I think you set it up as middle of the road as you can, Max. I appreciate that because otherwise I was just gonna have to say, like new phone, who dis, right?
Pass, pass, pass.
Like just pretend to freeze.
Yeah.
No, so there's a lot to unpack in any change in administration. A trade is a huge part of U.S. agriculture. We make more delicious, safe product here in this country than we could possibly consume, and we really do rely on those external markets to move that product. So trade's an incredibly important part. So having a good, solid trade policy look, and it could be tariffs or not tariffs, or negotiating or not negotiating, right? So that's one of the things that I'm paying attention to right now is what does trade look like in a new administration, no matter who is in that administration. And both candidates and their running mates are talking about tariffs, right? I mean, I don't think it's a single party issue talking about tariffs and how to enforce more fair trade policies with our trading partners. Our big three, right? Trading partners in ag are China, Mexico, Canada, to some degree, Japan, but the big three and perennially the top three trading partners are those three. So, that's going to be how do we negotiate future trade agreements with those three counterparties are a big deal. I also like to hear talk about other opportunities. So are we negotiating new trade agreements in parts of Asia that we haven't really before? Are we in India? Are we talking with Australia? So we're competing and we're trying to sell more to Europe. So there's just a trade is a very complex animal. And I think that's just one thing that the executive branch has a lot of not control over, but they have a lot of influence on trade policy. So that's one of the things that I think can be a big mover for U.S. agriculture. USDA, obviously, that's an agency of the executive branch. And so you can see changes in administration there. A lot of the people doing the work at the USDA don't change over, right? So the president may change a few cabinet members, but the people who are actually getting stuff done don't change. But you can see changes in focus, right, of different policy initiatives or different focuses. So I think that's something to keep an eye on. And we're in a farm bill year. So I think that's going to be a really interesting thing to watch. Hopefully we get something done sooner rather than later on that farm bill. But election time can play weird time warps with important legislative agendas, just as people want to see how's this going to shake out, and do we need to get something done now, or do we need to wait? But the farm bill is kind of caught in that push and pull of the election black hole. Other than that, I don't think you're totally wrong that there's a lot of life goes on afterwards. There's a lot of sort of churn. And consultants probably have more conversations about what happens next than everyday people. But it's the months and years after that election that things can start. You start to deviate quite a bit. That cone of uncertainty grows the further away you get as more policies can come through and more change can be affected. So I agree. I think that initially it's pretty small changes. There can be some big changes on the margin around trade and USDA focuses, but then it probably gets more impactful the further away you get from November.
Awesome. Thank you for dancing around that. And for those of you listening, wondering if we're trying to, one, I just don't want to talk partisan politics. It exhausts me. But the other part of that is Jackson here. It doesn't matter who's in office. He's got to work with the policies of either one, and souring to any perspective is not him doing his diligence and position and for that's how I look at mine as well. It doesn't matter who's in office. We work with people who sell and buy land, and it doesn't matter what policies are behind that. We're going to work with whatever. And to jump on either side of that does a disservice to if another party takes over or whatever. When certain policies come up, we can critique those, and whoever does those, we can talk about those. But when it gets speculative about administration, it does no good to try to say one's good or one's bad or one does one thing and one. And Jackson brought up a point before that it doesn't matter what's said on the campaign trail because those all change when someone gets in office anyways. So it just depends. Well, I actually not going to throw you. I'm not quoting you correctly, so I'm not going to say that was your quote. But we talked about things on those lines. So that's the reason for that, in case you're sitting there and wanting us to jump on a side or something like that, or if you want to call me chicken for not picking a side. To me, there is no side. It's just the marketplace, and that's so I wanted to make sure to discuss it on those terms. Okay, so we've gone through interest rates, we've gone through agriculture data, we've gone through elections. What else is on the horizon? And we talked about Farm Bill a little bit. Do you think that's actually going to go through this year?
I know smart people who care a lot about it are working hard on it. That's all I know, and I want them to do the best things that they can do to put farms first, and the farm economy is there's some stress out there. So all I can say is that we're already a year past its due date, and it would be lovely to see it. And I think I'm not alone in those sentiments.
I've been saying it for a while now, and it's probably the more what do I want to say, pessimistic outlook of things. Is I've been making the remark that I think they're just kicking the can down the road because no bill has ever come out without criticism. And if you could just defer that to the next administration, you'd be okay. I still feel like that's a thing, but we'll see. I don't know. Like, I hope to see it this year.
Yeah, I think you look at price levels and an ARC and PLC, and it would be, I think, a good time to see some of those get adjusted, right? So, but otherwise, I think there's good controls in place. I don't know the farm economy is not going to run, or the farm policy is not going to run off the rails just because there's an extension. But there's a lot of good that can be done in a farm bill, and trying to get something done. I understand the clocks are always different in every office on Capitol Hill, but getting something done it's just hard. No matter what environment you're in, there's a reason they call it an act of Congress, because it's hard to do, and getting it done right takes a lot of time, a lot of care.
Excellent. Well, I'm keeping track of the clock. We got a couple minutes left. If you have a couple points to hit us with, I'll leave an open mic. Anything on the horizon though should be looking out for?
No, I think the demand for farm debt is probably going to pick up. So as I talk to bankers across the country about conditions on the farm, about changeover in farmland, about sort of recapitalizing balance sheets, I think that is a common thread is, hey, there's going to be some additional need for some debt. And that could be either, hey, tap the equity that I have if I'm a farm land owner. As interest rates come down, there's going to be a little bit more interest in probably at 8% interest, there's a little bit less demand. When you start getting down to the fives, sixes and fives, people say like, hey, maybe it's time to diversify. Maybe I need to tap equity for working capital, whatever that reason is. We're starting to see that demand. Maybe that function might change a little bit more heading into 25. And then the higher cost of production expenses, that's going to require some additional dollars in operating lines. And so some debt sort of rolling over from this year to next if they can't market all the grain. So the demand for credit is kind of picking up, and I think the drop in interest rates couldn't happen any sooner to try to make that a more affordable increase in credit demand for next year's balance sheets and income statements.
Excellent. Well, Jackson, as always, pleasure having you your guest here and dropping knowledge on us. I absolutely appreciate it. Your organization has a wonderful news and research page up, and you put out your newsletters, and I can't remember. You don't have is a podcast that you guys run too?
No, we are. We're at the printed word now, but we maybe we'll have you on a podcast at some point.
Oh, there we go. There we go. I could be a guest on
cross promotion.
I don't know. I might hurt the brand name there.
No, you're right. The feed it's on our website farmermac.com. I encourage everybody to check it out. Our marketing comms team, team of economists, myself, a couple other folks on staff at Farmer Mac, try to cover really interesting stuff. We're putting a lens on what's going on in ag lending, in rural landscape, rural infrastructure, and how it all makes sense to the lending and capital communities. So it's a great read.
Excellent. I'll have a link for that in the podcast notes, and we can call that a wrap. Thank you very much for your time, and great having you on as always.
All right, Mac. You have a good one, man. Thanks for having me back.
This concludes episode 109 for the National Land Realty Podcast, discussing recent interest rate drops and their effect on agriculture and land values, with Jackson Takach, Chief Economist and Head of Strategy Research and Analytics for Farmer Mac. You can learn more about land ownership and the buying and selling of land at nationalland.com. And Jackson, you're going to have to stop being so good at your job, because if your title gets any longer, I'm not going to be able to pronounce it. I'm just kidding, man. Thank you for being a guest on this episode. Always enjoy it.